Jeffrey Cleveland, we had a weaker than expected retail sales number for September, a lower than expected CPI. Should we even be talking about a rate hike for the rest of this year?
Greg, I think it's still possible. It's still on the table, I would say. My confidence, my conviction level on that is lower now. But it's not because of the consumer or CPI. Consumer is still spending, it looks like to us, at a 3% annualized rate through Q3. So I know retail sales is weak, but take into account autos and other things, still looks pretty good. And then on CPI, I would advise investors to ignore the headline CPI that's going to be pushed around by your energy prices and focus on core. And the core print last week was rounded up to 1.9% year over year, which is fine. And then more importantly for us, Greg, we look at median CPI, which is a great measure that's calculated by the Cleveland Fed. They take, the CPI index, they run it through, they look for the median price change. So they're ignoring outliers. And that's 2.5% year over year. So that's not low inflation. I mean, it's low, but it's not below target Fed inflation. It's 2.5%. And that tells me, just on the basis of that, yeah, it's possible we could still get a rate hike.
What about wage inflation? Is people getting more in their paychecks?
Wage growth, if you look at average hourly earnings, which is what everyone points to, it's in the jobs report, it's sort of the hot line item, it's 2.2% year over year, which is low, but there's another way to look at wage. I'm always interested, Greg, in what everyone looks at and what's another way of looking at it. And it's, again, the median measure of the wage and income gains, and it tries to track, what a common person, such as yourself, makes this year compared to last year, or a person in a similar position. And it's put together by the Atlanta Fed. It's up 3.2% versus a year ago. So it's not, I would want personally more than 3% in terms of wage growth. I think you would too. But it's not as low as people think. So, and it seems to be trending higher.
All right, let's just take a quick look at the 10-year Treasury.
Sure.
Right? It's now yielding 2%. Is that reflective of the economy, the U.S. economy right now, or is it reflective of other things? Because once again, you're looking everywhere.
I think it's reflective of the global need for safe and liquid assets. That's the biggest, longest term trend that we have for longer term interest rates. So people around the world need to have something that's safe and they can put their money in, gets them a little yield, and they're choosing U.S. Treasuries. So that's why over the last 20 years you've seen yields falling. It's, I think, on a shorter term basis, when you see these ups and downs, these swings in longer term yields, it has something to do with the economic environment, inflation and growth. And in the last 6-12 months, it's the oil price, really. Oil prices plunged 50%. Bond investors said, oh, you can't have inflation if oil prices are low. Let's buy some bonds, and that pushed interest rates lower.
All right, well, speaking of bond investors, what should they be doing right now? Should they be running for the exits because yields are heading higher, or should they be sitting pat?
I feel like there's a series of recurring crises over the last 5 or 6 years where people have said, get out of bonds, interest rates are going up. At first it was this sort of hyperinflationary concern, when central banks were buying bonds, that was going to send yields up. Didn't happen. So the best thing for you was to stay in bonds. And now we're seeing another one. The popular story right now, Greg, is actually that China is going to sell all their bonds. And so you want to get out in front of that. And again, I think these are scare stories that frighten investors, and they turn out not to be the case. And I think, again, we're going to see that with bonds. In particular right now, I don't think we're as enthusiastic about a 10-year yield at 2%. But there are areas of the credit markets that have been beaten up lately. So your high yield and your investment-grade corporates, that could be an opportunity for investors as we head towards year-end.
And those corporations are not being unduly punished by the strong dollar. We're really putting it all together here.
So tying all the threads.
You have the worries about the Fed raising rates. That's making the dollar stronger.
Yeah.
That's not going to hurt multinationals here? Because we're hearing it in the earnings reports.
We hear it a lot. I think for the U.S. economy as a whole, though, a stronger U.S. dollar will be a good thing. For a consumer, you can buy more furniture, you can buy more cars imported than you did before. So a stronger purchasing power is actually good for you. So I think consumer spending is still 70% of GDP. In aggregate, the U.S. economy will be fine. Here's where I do worry, though, Greg. There are institutions globally, not necessarily U.S. institutions, that have issued quite a lot in dollars in a pretty short period of time. I think the issuance by those characters is up 50% in the last 3 or 4 years. And they will have to pay back their bonds in dollars. And if dollars are more scarce, they're stronger, on a global basis, it could be a problem for those sorts of institutions. So that would be non-institutions, non-U.S. institutions. For U.S. companies, I think this is a good environment. We're much more upbeat, I think, on the U.S. economy than many others.
All right. Well, thanks a lot, Jeffrey.
Pleasure to see you.
And thank you for watching The Street.